Is there a difference between the forex market and the stock market? In this video, I'll be sharing with you the 5 major differences between the forex market and the stock market. This will help you to better decide which is the best market for you to invest in, the forex market or the stock market. The first major difference between the forex market and the stock market is the opening hours. The forex market is open 24 hours a day, Monday to Friday. This is because it is not limited to any central exchange. This makes it possible for anyone to trade at any particular time, regardless of your time zone as an investor or trader. On the other hand, the stock market is limited by the time zone where the specific stock exchange is actually based. In general, stock exchanges trade between 8 AM to 5 PM on their local time zone. Beyond that particular time zone, you are not able to trade those particular stocks. So to be able to trade, for example, stocks in the New York Stock Exchange, you need to be able to trade when the New York Stock Exchange is actually open. So this can be limiting depending on what your time zone actually is. But with the forex market, it is open 24 hours a day, Monday to Friday. So what this means is that regardless of your time zone, you're able to trade in the forex market at any particular time that you are actually free during that working week. The second difference between the forex market and the stock market is the variety of assets that is available to trade. With the stock market, there is a large variety of companies that you are able to buy and sell. This helps with the aspect of diversification that is available to any investor in the stock market. For example, in the US, the S&P 500 index tracks 500 of the largest companies in the US, and that is just in the US and not all the stocks. But on the other side, in the forex market, there are only 7 major currency pairs for you to be able to trade in. While it might seem a disadvantage, having fewer forex pairs to actually focus on helps a trader to be able to specialize on these particular major currency pairs and to be able to become a master in their movements and to be able to make a capital gain from them. The third major difference between the forex market and the stock market is the market directional bias. What this means is that in the stock market, it is mainly biased towards long-term uptrends. Most of the participants in the stock market mostly look to be able to buy and hold a stock over a long period. This makes the bias of the overall market to be mainly bullish. But in the forex market, there is no one particular directional bias. That is, there is no either a strong bullish bias or a strong bearish bias. Over time, a currency pair keeps changing in its directional bias. There are times when it will be more bullish, there are times when it will be more bearish. So this provides a very good balance between the buyers and sellers, and it ensures that one can make money in any particular direction. The fourth major difference between the forex market and the stock market is leverage. In the forex market, there is the availability of leverage. What this means is that we are able to amplify our initial capital to a large amount so that we can be able to amplify our returns. But in the stock market, leverage is rarely available. What this means is that if a stock of a company goes up by 1%, the maximum that you can actually make is actually that 1%. So while leverage can be a dangerous thing for any particular trader, in the forex market, with a good forex trading strategy, you are able to make a good return from even small price movements in a currency pair. The fifth major difference between the forex market and the stock market is liquidity. The forex market is considered the most liquid market in the world. The benefit of this is that we are able to get in and out of trades very easily and be able to get almost instant execution of our sell and buy orders. So this means that we are not stuck in any particular trading position. We can get out when we want. With the stock market, liquidity is not always guaranteed. For example, you may be holding a share of a particular company, but if, for example, there are no buyers on the other side of this particular trade, then you'll not be able to sell off your stock. And there have also been times when company shares have actually been halted from trading in the stock market for days and even up to months. What this means is that your money can actually be locked in a particular share and you may not be able to liquidate it to be able to get back your initial capital. To learn even more about the basics of the forex market, then check out the playlist on your screen that goes in depth into other important forex basics that you need to be able to master. And to learn more about forex trading and investing, then click on the subscribe button below. You will love the content. So see you in the next video.